more seconds and we're going to get started. All right, everybody. So today we have a very special guest who's going to come on and share a lot of his expertise on the multifamily space. He's local here in Austin. Matt's known him for a long time. And we're really excited to have him on here and share his experience and knowledge with you guys. Right now, I'm going to go ahead and have Matt introduce him, and then he'll hop in. We'll get started.
All right. Yeah. Thank you guys for tuning in. We're lucky to have Kyle join. Kyle, thanks for your time, man. Kyle and I met maybe like 4 or 5 months ago. We had lunch together, and I kind of had seen him online and seen some of the stuff that he was doing. He works with a guy named Nick here in Austin as well on some projects. And Kyle, I'd love for you to get a little bit into your background, but basically, in my view, Kyle is very successful in multifamily. He's acquired properties, he's analyzed properties, he's been studying it for a long time. He has a podcast and a lot of stuff that he does on his own social media, and a really good guy to get connected with. So feel free, guys, to jump in and ask him questions. He's super easygoing, and he's obviously willing to help. That's why he's here. And a couple of you guys requested kind of a little bit of high level, and we can get like as detailed as you want as far as analyzing apartments. So Kyle, man, would love for you to jump in, and thank you for joining.
Yeah, thank you so much for having me. And just to get into my story a little bit. So I'm 21. If you're wondering why I look so young and you may be perplexed by that, well, yes, just to get that out of the way. Yeah, I am 21. I dropped out of school at UC Davis my sophomore year to pursue this full time. And since then, I've been able to do 2 deals. Syndication is the method that I use, which is basically raising private capital to buy apartments that I otherwise wouldn't be able to afford, and then running them and providing returns for investors. So that's been my MO. And I have 119 units at the moment in multifamily. So that's been a cool journey for sure. And as far as like the format goes, I guess like using the chat to just let me know questions as I go through, because if I'm talking under you or over you, just let me know, because I don't want to talk under and waste everyone's time, but I also don't want to talk over and lose everybody either. So feel free to put that in the chat and just ask as many questions as you can. As far as what I wanted to go over in the underwriting arena, which would be basically underwriting. To define underwriting, it would be basically understanding, is this a deal a good deal numerically as far as analysis is concerned? So we're thinking about, is this property going to make us money? And that's kind of what I'm hoping to go over. So I don't know, Matt, do you want me to just kind of get into it at the moment? Yeah. Okay. I think you're on mute, but I think you just said yes. So, so I will, I'll get into it. And basically what I want to talk about is, number one, what it is on an overall basis, and then kind of go into the granular aspect and define some terms, show you guys what accounting looks like in multifamily, as far as I'll share my screen, and we can go through a T12, which is basically a T12 means a trailing 12 months of profit and loss for a building that you're looking at. So we're looking at the income statement of a property for the trailing 12 months up to the point of date that we're at now. And that gives us a sense of if this property is performing in the way that it should be, or if there's some areas where we can add value. And the 2 big drivers are, of course, profit or income, and then loss. So we're looking at the income lines, which is predominantly rent, but there's also a category called other income. And we'll break down what's in other income. But essentially, we're looking at, is the rent going to be at the market rate, which is basically saying, are the properties around it getting more rent than it's currently getting? And what is that market rent, and how can we tell? And so we'll get into that a little bit as well. And we'll see if is there any possible way for us to raise that rent, because that's essentially how you're going to raise the property's value. So a lot of you people here may be from single family or residential space for that matter. And the way that those properties are valued is on comparable units. So residential is essentially your property value is directly determined by the units around you and the comparable units. So if my guy next door has really cool granite countertops, then I better get him too, because that'll directly impact the value of my property. Well, in commercial, it's slightly different. It's about a formula, which is NOI divided by cap rate equals the purchase price. So the purchase price is actually calculated on a formula that is set, and that is NOI divided by cap rate. So what is NOI and what is cap rate? NOI is the net operational income, or essentially the profit before debt service. So the money the building makes before you pay a mortgage, because it's assuming that you bought the deal in cash, since everyone is going to get a different mortgage. So there's no way to standardize an NOI if it's after debt service. So it's pretending that you've bought it in cash and have no debt service. So what is that NOI? And the way that you would raise that would be to cut expenses or raise income. So that's the whole thing we're trying to do, right? Because that is the biggest lever in our formula for value is the income or the profit of the property. So net NOI. And then the cap rate is the market valuation of something. So essentially what people are willing to pay for an asset within a market. So if it's a 10 cap, let's say, let me get the calculator out so I can make sure I do this right. Like let's say you have $100,000 NOI. If you divide that by 0.01 or 0.1 for 10%. So if it's a 10 cap, essentially to break it down would be, if it's a 10 cap, someone would pay $1 million for a building that had an NOI of 100,000. And if it was a 5 cap, someone would be paying $2 million. Because you're taking the NOI, which is 100,000, and you're dividing it by the cap rate as a percent. So it would be 100,000 divided by 0.1 for 10, and that would give you $1 million. So you'd have a $1 million purchase price. And on a 5 cap, you'd have a $2 million purchase price. So the lower the cap rate, the higher the purchase price. And the higher the cap rate, the lower the purchase price. So there's a couple different things to consider when you realize that it's that inverse relationship. Let me pull up the chat just to see if there's any questions. Cool. Yeah. To keep it simple, 10. Yeah, that definitely is an easy way to keep it simple as well. But if you're considering getting financing, which most of you will, then there's a little bit more of a complex thing to think about as far as cap rate. And Gustavo asked a good question that kind of helps me segue into my next point, which is, so you want to buy at a higher cap rate. Well, that's not necessarily true. There's benefits to buying at a lower cap rate. And I would advise people not to demonize one or the other, high or low, because there's benefits to each. So if you buy on a low cap rate, that means that formula is going to be multiplied greater. So everything that you're doing is going to be compounded on the back end as far as purchase price. So if I buy at a low cap, let's say a 4 cap, and I make a very small improvement to the property, that's going to increase the purchase price much more than if I was on a higher cap. Right? Because the NOI is an inverse relationship. So if I have a higher NOI against a lower cap rate, I'm going to have a higher purchase price. But if I have a higher NOI on a higher cap rate, then my purchase price isn't going to be quite as high. So it's kind of decent on the buying side. Yeah, you get more NOI for less purchase price up front. But on the ownership side of things, on the selling side of things, which you have to consider the whole ownership period, because that's what returns are dictated on. And you can sell it for quite a bit more and make less improvements and see more of an income or more of a value play on the back end if you have a lower cap. So some people, what they'll do is they'll buy a very low cap market, like let's say Los Angeles, and they'll increase the NOI in Los Angeles on a 4 cap because they'll see so much growth in the purchase price on the back end when they go to sell. Whereas if you do that in the Midwest, you have to raise the NOI a lot more to see the same bump in value because of that cap rate. So don't immediately be like, oh, I only want low cap, because you're somewhat limiting yourself. You're going to get more cash flow, but you're going to get less yield. So it's kind of a preference thing. So that would be my whole opinion on cap rates for sure. And that's something that new investors do quite a bit. And I did this myself. That's why I know. I would tell brokers, hey, I only buy 10 caps or I only buy 8 caps. And typically what that tells a broker is that you don't have a flexible understanding of a cap rate. And if you don't have a flexible understanding of a cap rate, it's typically because you're not as experienced. And then that's kind of a red flag for brokers. Is so if you're talking to brokers about multifamily and you're like, yeah, look for this cap rate, then they're going to be like, okay, you're probably not someone who's going to seriously close, like that I'm confident on. So you may not get their insider deals at that point, or you'll have to really prove it to them that you can. And that's not a good space, because unfortunately in multifamily, there's a kind of an old boys club situation happening where if you don't know the brokers on a personal level, then it's typically hard to break in. So you have to be credible by using the right lingo. And that's kind of the important aspect of cap rate. So the whole thing is, right, we're trying to find a way to increase the NOI, and we're trying to know what our cap rate is so that we can find out our purchase price, which informs our whole purchase decision, and it also informs our selling on the back end. So it kind of all revolves around that formula. And so to break down that formula, we have to break down the income. Ricky, what was your process to do that, to get plugged in with brokers? Yeah. So a great process for that would be, if you've ever been on loopnet.com, it's typically very bad for finding actual deals. And you won't really find any good deals on there, but you will find almost every broker in the country has an account on loopnet.com. So you will be able to find the broker's personal information on LoopNet, and from there you can reach out. So what I do is I'll go to loopnet.com/broker directory. And what you can do on loopnet.com/broker directory is you can sort by city and by asset class. So you can sort by multifamily and by Austin, or by multifamily in San Antonio, or wherever it is that you invest. And you can go through about a list of 40 something, like 40 pages of results on brokers who are in that area and in that specialty. And from there, when you click on their account on LoopNet, it'll have links to their personal webpage. And when you're on their personal webpage, you can start to see, number one, what deals they offer, and start to look at those and see if they have any good deals and maybe look at some of them and analyze them. And then number two would be you see their contact information. So you can send them an email. And that's probably the best way to start reaching out. And that intro email is really, really important. So it's not just saying, hey, I'm Bob and I'm looking for multifamily in Austin, because they're going to say, hey, man, I got 100 emails today from people looking at multifamily in Austin. You have to say something to set you apart. And that's typically why going to their personal website and looking at their deals and underwriting a little bit of it at least. So they'll have typically deals under our properties. It's pretty much every broker's website's laid out the same. It'll say something like our properties on their page. When you go there, you'll have to sign in. And when you sign in, you'll see the ability to go and, well, number one, they'll see that you signed in, which is important because they'll know your name already. They'll be, oh, this guy's been signing in my website. But then you're able to download the financials directly from the website. And that allows you to start to actually analyze the deal and send them some feedback like, hey, I saw on your website you had a 140 unit in South San Antonio. I really like the deal, but, and then you tell them what you didn't like about it. And that gives you an opportunity to clarify that you know what you're talking about, show yourself as a legit investor. And then thirdly, it allows you to further refine your criteria. So why is it that that you don't like it, right? It's because you're looking for something else, right? So what is that something else? And defining that. So, oh yeah, this deal doesn't work because it's in the wrong part of town, or it doesn't have the income value that I want to actually be able to add. So the rents are already at market. There's no meat on the bone for me to add. My strategy is predominantly value add. So I'm looking for a property that's underperforming at the current moment, and that I can reach into it and make it perform at the level that it's supposed to. So if it's already performing at a peak level, it's a stabilized asset. I'm not looking for that. So now I have the opportunity to, number one, give good critiques and show that I'm legit, but also to further tell this guy what I want. And it's a whole lot better email than, hey, I'm looking for multifamily. Because I tell you, man, like, it's crazy how many emails these guys get. They get thousands of emails a week from people who are looking for multifamily in their market. So you have to set yourself apart. And they're often going to give you the whole gated approach where they'll have these certain blockages. So first email, they won't even respond. Second email, they'll send you the worst deal that you've ever seen. So it'll just be like an absolutely horrible deal that no one is expected to really buy. It's probably one that they've been sitting on for years and that no one's really touched, or months and no one's really touched. And you have to underwrite that deal earnestly and be excited about it and give them the best feedback that you possibly can on, even though it's a bad deal. And then further refine your criteria, as I just talked about, which is, hey, this deal doesn't work because X, Y, and Z, and I'm looking for this. And so you do that, and they'll probably either not respond or they'll send you another bad deal. And then from there, you underwrite that one, you do the same thing. And that's a kind of a process of a loop there that'll happen. And after a while, they'll start to see, hey, man, this guy really does send some good feedback back quickly. I've sent him a couple of bad deals. Maybe next time we get actually a good deal, maybe I'll send it to him with the list of people who I send my good deals to. And then from there, you can start to work your way up that list. And now you're kind of in the inner circle, and it becomes a process of developing a personal relationship with this guy, having lunch with him, and trying to get him to know him a little bit better on a personal basis. So that's kind of the flow there. And just don't get discouraged if someone sends you horrible deals. In fact, I guarantee that it's going to happen. So that's just something to be prepared for and not get discouraged by. And in fact, take it as like a challenge, right? You're almost like, I took it as like a personal challenge. Like, let's see, like, this guy wants to just like get me to go away. I'm going to make it so hard for him to get me to go away that eventually he's going to send me something. And I want him to be like, who is this guy? He's emailed me every week for the last 6 months. I'm going to meet this guy. I have to at this point. And that's kind of the mindset you have to have, is like, this person is trying to ignore me. I'm going to make sure that I can't be ignored, and just continue to kind of hit them with emails and review and analysis. And eventually you will break through. It's just a matter of time, because not very many people are persistent enough to keep doing it. So if you can be persistent, even for a couple months, you're going to be way ahead of 99% of people, and you'll immediately get into that kind of inner circle where as soon as they do get a listing, they'll send it to you along with potentially, 10 to 12 other people in the market. So there's still competition there. You're not free and clear yet, but you have now the opportunity to at least fight among those 12 and hopefully get closer and closer up into the top of that group and eventually get some deals first, which would be awesome. Once you get it first, that's when you actually can close. When you're in the top 5, then you have a decent chance, but the market is still competitive right now. So there is a little bit, it's going to be difficult regardless. And I'm not going to sugarcoat that, because I find that sugarcoating doesn't necessarily help anyone. So I will definitely say that, yeah, it's going to be difficult, and it's going to take a lot of months, and it's going to take some serious persistence. But if you do it long enough and hard enough and consistent enough, you will definitely get a deal. It's really a numbers game. So the more output that you have, the more likely it is that you'll close the deal. So that's essentially the broker reach out process broken down. To break down the actual underwriting process, I think it would be helpful to look at a T12, which is the trailing 12 months of profit and loss. And I've color coded the one that I'm going to show you because oftentimes you'll get some really bad accounting. And so I've consolidated this into some solid accounting, and I've color coded it and put it into income categories based on the deal analyzer. So let's see. Lines in the water, consistent approach, I gotta get these chat box up. Taking everything as a challenge. Yeah, exactly. So that's awesome. I'm going to share my screen. I'm going to figure out how to do that. Present now, I believe. Your entire screen. Can I do like different monitors? Interesting. Huh. How do I make sure that I present my actual one?
So you should be able to, when you click present, you should be able to click which screen you want to show. It should pop up and say like.
What should it say? Because it's just saying present your entire screen. I'm trying to think. What can y'all see right now as I'm presenting? Oh, just like an endless loop. That's pretty freaky. Let me stop doing that. Maybe if I pull it up on this browser, because I have two monitors, so maybe that's the issue.
It should be right below the present entire screen. It should have something that says present a window, and then it should give you all your different.
Okay, yeah, I was looking for that. It just has that one option.
That's so weird. Mine has one right below that says present a window, and it gives me all my monitors.
That would be sick if that was the case. Let's see. And change Safari setting and preferences. It could be because I'm on Safari. I mean, why am I? Super weird.
That's working. So now if you, so that was working, Kyle. If you go to whatever screen you wanted to go after that, it should work.
Okay. Okay, so maybe if I go like, can y'all see a Excel document at the moment or no?
Yes, sir.
Okay, awesome. And does it say Treetop T12 at the top?
Yep.
And y'all can see my cursor?
Yep. You're all good.
Okay, sweet. Okay, let's go. Awesome. So yeah, this is what a T12 looks like. So you'll have the income line up here on column 8. And yeah, so the only thing is I can't see the chat box at the moment. So just feel free to unmute yourself and ask the question. I mean, I know that's kind of courageous, but if you really do have a question, please feel free to just do that. So here's the income line. And basically, this is where you're going to see the market rent, which is right here and broken down by month. And then you have the total here. So this is the 12-month total, and these are the months. And so gross potential rent, this is an important like lingo thing to get down. This is essentially saying this is what the rent would be if they were all at the top rent that you could get for them. And also they were all occupied all the time, which is kind of a theoretical number because there's turnover. So you'll never actually be at 100% occupancy. It's impossible pretty much because you couldn't get someone to move out and then a new person to move in the same exact day. So there's always going to be at least a little bit of vacancy. And so it's kind of a theoretical number. It's more of an accounting thing. So what you're doing is you have the gross potential rent, and then from there you deduct vacancy, concessions, loss to lease, and things like that. So here we have vacancy loss grouped into one category. I'm assuming that, so this is what you'll often have to deal with is like, they ideally would break this down into multiple line items saying loss to lease and then vacancy loss. So you would know which time is it empty and which time are you losing rent from the market rate to the actual rate that you're receiving, which is the loss to lease. So if the market rate's 1,000 and the current rent is 800, and I have a $200 loss to lease, so that's typically one of the deductions that comes out. But right now they just have it grouped into vacancy. So they've lost about $100,000 this year from units just not being rented in the vacancy category. And then you have concessions, which are basically things to incentivize tenants to move in. So 1 month free rent, things like that. That's a concession. So those have been deducted from the gross potential rent. And that gives us an effective rent. So the effective rent is the actual rent that's effectively being received, right? Because this is theoretical, and then this is what actually is effectively received. And then from here, we have some other income. So other income is income other than the rent. So we have that broken into color-coded categories here. We have fees, and we have utility reimbursements, and then the others are their own line items, so laundry, pet, and vending. And so we have here the fees, which is obviously fees because they all pretty much end in fee right here. And you'll get fees like admin fees, application fees. So admin fee would be like, getting everything set up for a new tenant to come in. Application fee would be the actual fee for the application itself, for getting someone's credit checked and all that good stuff. And then they have some other ancillary fees here as well, bet fee, eviction fee, things like that, that they've counted as other income. So we have to account for that. And all I've done here is a simple auto sum. So if you're not familiar with that Excel, all you would do is click the auto sum button and then select the range. So you can see here, that's the range I've selected, and it's auto summed and giving me the formula there. So I can just see that the categories there, and I'll put that in my calculator in a second that I'll show you guys. So that is what I'll put the fees thing. I want to get the 12-month total for my calculations. And then I want to do the utility reimbursements, which is getting billed back for utilities like gas, water, pest, trash, those kind of things. And thankfully they have it in parentheses billed back, which is helpful. Often you may see even like a lot worse accounting than this, which is just something where you have to be creative and kind of try to work backwards as to how they were thinking and see if you can't get the same numbers together. So vending machine would be the income from a vending machine. So I've left that separate, as well as laundry and pet rent, because those are all important things to keep separate. And those are all going to be their own line items in my calculator. So basically in the calculator, what we're going to do is, and I'll show you in a second, we're going to put the GPR, the gross potential, then we're going to put the vacancy loss, then we're going to take the effective, and we're all just basically plugging these numbers into our calculator. And the calculator is going to show us what we can afford. Can we afford to pay the bank with the income that we're receiving from this? And then also, as you break it down more, how much money am I going to make on this deal? So there's two real main questions. Can I pay the bank? Number one, first and foremost. If you can't pay the bank, then stop there. It's not going to work, because if you can't pay the bank, you can't pay yourself. But first, you got to pay the bank. Can I pay the bank? That's determined by something called a DSCR, or debt service coverage ratio. And essentially what that is, the NOI divided by the debt service. And basically what that's saying is, do I have enough income produced by this property after expenses are said and done that I can actually pay my mortgage? And that's basically the question there. So if you can answer that question as confidently, yes, I have plenty of money to pay the bank, then you can start thinking about, okay, well, with that money left over, how much are my returns going to be for me personally and for my investors? So that's the question we'll answer later. But right now we want to get the basics. Can we actually pay the bank? So here's the other income category. And then we have the effective gross income, which is basically all the income gross before expenses and the effective gross that we're getting. So here we have the expense lines that are coming in here. And let's see if we have the totals. Yeah, so the totals are a little bit off here. Let me zoom out so y'all can see. So yeah, we have the repair and maintenance category right here in blue. And you can see here that these are clearly repairs. You have literally repair in a couple of them, which makes it easy. Then you have things like cleaning, which I would consider maintenance. Things like painting and drywall, which again, I would consider maintenance, and things of that nature. So we're basically repairing and maintaining the property. And then I've summed that and we've gotten the number there. Then we go into green, which is utilities. Again, this is a easier one to tell because that's obviously just what utility expenses there are. Then we go into admin, which is a little bit trickier of a category. Admin would be administrative fees or administrative expenses like the telephone, the office expenses, application processing, all the little like niggly things that you have to do as a admin. And then you have the softwares, of course, and there's even sometimes like travel for the owner coming in to and from the property. So that's that kind of situation. Then we have the contract services, which is anytime that we're contracting someone to come on property. So we have things like, permit fees and licenses. I'm assuming that you'd have to potentially contract someone out for that, landscaping especially, and then legal and professional fees. You can often make your own line item for legal and professional fees. I've chosen just to group it under contract services. So this is the cool thing, is like you can kind of do the accounting however you see fit as long as you stay consistent. And that's really the main thing. But as long as it makes sense to you and you stay consistent, then you can kind of do it any way you want. You'd ideally want the T12 that you have to just be given to you grouped already. But like, for example, here we don't have it grouped. And this is kind of why I use this example, because sometimes you'll just have it nicely grouped and it'll be perfect T12 and it'll make your life easy. But a lot of times you'll have this situation where you have to then go and group these things and make it make sense. So that's what I'm doing here. And we have marketing, which is a pretty clear one. So that's advertising, monthly publications, pretty obvious there. Then we have payroll, which is again, somewhat obvious. We have salaries involved here. And one thing that I do want to point out here is I've noticed this immediately, which is the lead maintenance guy. If you look at his salary, he's making $90,000 a year. It's a pretty solid lead maintenance guy salary. I don't know about you guys, but I think I might even do that job for $90,000. So that's something where I'm looking and thinking maybe that individual is potentially being overpaid. And the reason I can say that with some confidence is that he's not alone, right? There's another manager and there's an assistant maintenance person. So there is some other people involved here, and he's still making $90,000. And these people are making 70 and 55. So it seems like potentially there's an overpay there. And typically for my market, Austin, the payroll expense is about $1,000 a door per year. So if we're over that, when I put this into my calculator, then we have a clear idea that maybe they're overpaying. So that's something to consider and something that we'll keep our eye on. So that's kind of some of the notes I'm trying to make to myself as I go through. Is like what things really stick out and are like seem a little bit crazy. And this is common sense, right? Does $90,000 seem a little high for someone who's a lead maintenance salary guy? I think that's a little bit high. So we're just keeping a mental note, and we're going to see if it's over our average or over what we expect to pay someone in the market. I'm pretty positive that it will be, but we're going to wait and see what the total comes out to. And so then that gives us our operating expenses here totaled here, and then it gives us our net operating income. So our NOI is $648,000, and that's before debt service. So that's the net operational income. So now what we're going to do is we're going to take all these numbers, and let me slide over the deal analyzer. And let me know if y'all can see the deal analyzer that's up now.
Yep.
Okay, cool. Thank you. So here is the back of the napkin kind of thing. So if you look at this, the back of the napkin is pretty simple, but then we have returns here. And I'll just go over the analyzer basically. So we have the kind of the returns table here. We have some, I should get this little doc out of the way. So we have assumption tables, which allows us to run different scenarios next to each other. Worst case, best case, everything in between, toggle back and forth, and they change the actual returns on the summary page. So we can see like, okay, what happens if we buy it at 12 million? What happens if we buy it at 12.5 and 11.9? And we see everything in between also with different loans. So if we get a bad loan or a good loan, and then we see the LTV changes, we can also see that. Then we can have a refinance or not. And if we say yes, then these cells will light up blue for us. If we say no, then they'll stay gray. And then we have some stabilization assumptions, some sale assumptions, and some other things like that. So this is just how you would vary what happens. So you're basically, the big thing about underwriting is it's somewhat of a science, but it's also somewhat of an art in the sense that we're predicting what we think the environment's going to be like in a 5 to 7 year period. So essentially we're guessing, right? We don't know the future. So we have to have some assumptions there. And so we have the ability to try different assumptions and see what it does to our deal returns. So that we can say, okay, worst case scenario, we have 12% vacancy when we buy the thing. Best case scenario, we're 5% vacant. And then we see what happens to the deal when we have this much vacancy and then this much. And we see what happens when we never get it that stabilized. So we're always at 93, 7% vacant all the time. And then we have one where we get it down pretty low to 3. And so we're just thinking, what happens worst case, best case? And then we have different ways to split the returns. And so we can split the returns with our investors in these ratios. And then from there, we're able to even split up what we're going to make personally, because usually GP, which is the general partnership or the people who are actively involved, not the guys who are just giving the money, but the people who are running the deal, like myself, there's typically a couple roles within the GP. So we're able to actually label those roles and then give each individual partner a percentage so that we can decide who's going to make what before we actually do the deal. And you can see those returns for the partners on this page by the dollar amount. So you know, if I'm a partner in this deal and I'm doing the acquisitions side of the GP, then I'm going to make $114,000 year one, and I'm going to make $590,000 year the total time. So you can see kind of what you're going to make, and then you say, oh, I raised the capital for this deal, and I'm a GP. Well, I'm going to make $80,000 the first year and $413 the total year, the total returns. And then, oh, I put up the earnest money deposit, and I put up the inspection costs, and I'm a risk capital guy. Well, cool. I made this much this year and this much total. And then I signed on the loan. I made this much year one and this much total. So that's kind of cool. You can see what your GP's at. And then another cool thing that we've added here is the break-even occupancy. So this is really good for confidence, right? I know that this property can drop all the way to 75% occupied, which is, you know, you're losing 25% of your tenants, which is pretty unlikely. In coronavirus right now, we haven't really dropped below 90. So this is where you break even. You can pay the bank back 1-to-1. So you're right at the issue of not being able to pay your mortgage. So you have a lot of buffer there, and you can make a lot of mistakes, and that makes you really confident when you're going into the deal. And it makes you feel like, okay, as long as I don't really, really catastrophically mess this up, we should be okay. And that's nice to know. And then from there, we have things like detailed income, which is where we're gonna talk about this later. We may not even get into it because it's a little bit too much, but we will definitely talk about the basic analysis. And yeah, basically these are where we're gonna put the income, I mean, we're going to put the expenses here, and we have the ability to project what it's going to grow at each year. So what it's going to increase by percentage wise. So we have a 3% growth on insurance every year, a 3% growth on payroll, et cetera. And then we get to see the whole thing broken out by month. So I can literally see what this property is going to perform at by month and by year until the whole period is up. And it'll even calculate my purchase price at the sale year here at 16 million at the sale. So we know exactly what we're going to sell at. We know what the profit's going to be for it. And we know how that's going to be split. So that's pretty cool stuff. And we can see every month by line item. And we can even see the loan schedule if we want to get fancy with it. And we can see what the loan's going to amortize at, which is cool. But yeah, let's just get into the basic analysis to keep everyone on board. So here we have the purchase price, which is pretty simple, 12 million for the purchase. And we just put in some of the closing costs. We're making assumptions here. And then we are going to come into the financing, and we're just going to get a standard 70% LTV loan. And we're going to look at the local interest rate for Fannie and Freddie. It's around this mark at the time. So we're putting it here. And then we're going to go into what we just talked about in the T12. So this box right here is just the T12. It even says trailing 12 months here. So remember this whole thing we talked about, the gross potential rent and the gross other income. So we're going to just take those from the spreadsheet that we looked at. And so I don't have to switch back and forth between the screens, potentially lose people. Let me just see if it's crazy. So yeah, we should be back at the T12 here. So what we're going to do is you can see the gross potential rent is 1,491,333. So we're going to take this number and we're literally going to plug it in here. So you can see it's the same number. And we're going to do that across all of the things that we categorize. So if you saw those categories, that's why I broke it into them, because I'm going to put them here. So we have, real estate tax category, like we talked about, insurance, prayer and maintenance, general and admin, marketing, contract services, utility, and payroll. So these are the same from the T12. I literally just copied it over and made them into the categories. And then I'm taking the number and I'm also going to copy the number over. So that's going to give us the same total expenses and the same NOI. But the cool thing about the calculator is now we can see the ratio of operating expense to income, and we want to be around 50%. That's typically the rule of thumb. So we're a little bit high on operating expenses. So they may be spending a little bit much. And remember what we talked about with that payroll, that guy making $90,000 a year. That's kind of high for payroll. So that might be what's contributing. So we're just keeping note of that. And also we can see the per unit. So you'll remember that I made a comment on Austin being around $1,000 per unit for payroll. They're at $1,600. So they're overpaying. Like, I'm pretty confident about that. And that's also reflected in their ratio here, because they're at 57, not 50, which is not a huge deal. You're not always going to be at 50, but 57 is slightly high. And then we also have the understanding that they're potentially paying this individual $90,000 and that they're over the average rule of thumb by a significant amount. So we're going to be able to probably make cuts there. And that would be my first order of business, would be to get a quote from a property management company for a manager's salary in this area and assets like the one that I'm trying to buy, and see if it comes back under 90,000. I'm pretty confident that it will. And then we'll be able to add that new quote as our assumption for payroll. So we'll say, okay, I just got a guy who said, if I buy this property, he can work for me for 45K. Well, then I'm probably going to underwrite that I'm going to have a new payroll guy at 45 instead of 90. So that'll be that situation. And let me check the questions just in case we've got any. Do you think they're overpaying because Austin is a strong economy or mismanagement? I think they're probably overpaying. I don't know any reason for them to be doing it because of Austin as a strong market. And also owning in Austin, the average would be $1,000 per unit. So I already know the Austin amount. So this is taking into account that Austin is a, like you said, a popular market, kind of more of an expensive market. And I still know that in Austin specifically, it's 1,000 a unit, which even is high nationally. So 1,000 units pretty high nationally. So I'm already kind of accounting for Austin being an expensive market to employ people, and they're still even overpaying over that number. So like if I own in Louisville as well, and the payroll expense there is a lot lower than Austin. And even this is still over the Austin. So it's not necessarily that Austin's kind of an expensive market. We're just overpaying there, and $90,000 a year as common sense individuals, and like us just not even really knowing what this guy's roles are. I still would say to manage an apartment building, you have and this is the lead maintenance guy, right? This is not the regional manager or anything for the company. This is just a lead maintenance guy. So I'm not sure where the 90,000 is being justified. He may be an all-star, but I still think 90,000 is kind of high. So, and it definitely is. So we're just going to see if we can't get a new quote, see what's up, maybe ask some questions. and then make an assumption on payroll later. So that's that. And then for cap rate, so this is that cap rate we were talking about earlier. So this is around a 5.4 cap. If we were to buy it at that $12 million purchase price that we have up there, and that's just something to see. And then here is the cap based on the year one income, but this is the actual income today. So we're buying at a 5.4 cap. And I want to show you guys what happens when you change purchase prices, what happens to the cap rate. So let's say I pay 13 million instead of 12 million. The cap rate should go down, and it has. So 4.99 now, right? And then if we buy this at 11 million, what's going to happen to the cap rate? So now it's up to 5.89. So let's bring it back to 12. Cool. And then it's back to 5.4. So that's kind of a good thing to see here. And then the debt service coverage ratio is the ratio of the debt service to the actual NOI. So you can see here, I'll even show you the formula. It is just the NOI divided by the debt service. So that is where you're going to get the formula here. And 1.4 is so basically we have 40% more income than we need to pay the bank. Because if it's a 1.0 DSCR, then if the mortgage is $50,000, we have $50,000 to pay that mortgage. So we're 1 for 1 if it's a 1.0. If it's 2.0, then we'd have double the money we needed to pay the bank. We want to be above 1.25. And if you are, this box will turn green. And then that means that, okay, we can finish the basic analysis and we can go on and do some of the more complicated stuff. Because once we do these over here to the right of basic analysis, we get beyond can we pay the bank and we start getting into, okay, what do I make? And that's reflected in, the returns page. So what are these LPs making? Well, if this guy gives me $100,000 today and we do this deal, in 5 years, it's going to turn into $191,000. So we're almost going to double this guy's money. And that's reflected here in the equity multiple. So if this number was 2.0, then this guy would be making this 100,000 turn into 200,000. So we're just shy of that at 1.92. And that's pretty sweet. We want to be around that number. That's why it's green, as you can see. And then equity, the LP IRR is, we want to be above 15, somewhere around there. We're at 16 on this deal. And then the average annual return is 38.39%. So that's pretty sweet, especially if you're comparing this to the stock market, which is, typically around a 7% return. And I'm being a little bit generous with that number. So that's just a good thing too. Also, if you're pitching investors, you can tell them things like that, right? Because the average annual return is obviously inflated because of the sale year. And that would be a decent argument against the average annual return being an accurate metric. But the thing is, real estate has the benefit of being able to have a big sell year, and also defer the taxes on capital gains. So I would kind of make the argument that one of the benefits of real estate is that big fifth year, and therefore it should be reflected in the average annual returns. But again, IRR is probably a much more accurate return metric. And that's why I typically use that, because it's better for comparing across different asset classes. And that's why people use it so much. And then the equity multiple is a good conceptual thing that people can wrap their heads around. So I typically include that as well, because it's pretty easy to understand. If I have 100 grand here, it's going to double in 5 years and turn into 200,000. So that's kind of a cool thing. I think I heard another chat, so I'll go look. Okay, so Gustavo asks, before going into a market, do you study it, or is it based on the financials? You mentioned you own in Louisville. Did you research Louisville market first? If so, what do you typically look for? That's a great question, Gustavo. Yes, you absolutely should research a market. And I would actually make the argument that not being from a market is almost a benefit, because I do this thing, and I think we all do this thing, where we think we know something and we don't really know it, right? Because I'm from Austin. I grew up here. So at times I try to say things about Austin that are anecdotal. I'll be like, oh yeah, when I was a kid, this area was X, Y, or Z, and that's why it's nice. So it's like, well, if I actually look at the data, I may see a completely different story, and I may have a cognitive bias. So I've found that investing out of state is actually almost caps my emotional involvement, which is good as an investor. So what you're looking for is, number one, you're looking for population growth, because as more people move to a market, there's more demand for housing or rent. And then as supply stays the same in B and C class, you're actually going to be able to have the rents go up and have more occupancy. So that's population growth, number one. Then you're going to be looking for job growth, because as more jobs are created, there's more ability for people to have income and more ability for them to pay rents. Then you want to look at the median home and condo value, because as houses get more expensive in the market, then people are actually able to pay for more things, right? Income is going up in the market. Therefore, rents will track with that home price increase. Then you want to look for the poverty level in the specific submarket. You want to look for unemployment rates. You want to look for basic general things. Another one that would be more specific would be absorption rate. So the absorption rate is basically how quickly are new units that are being constructed being absorbed. So if someone builds a 100-unit complex and no one moves into it, that's probably a sign that, you know, the market doesn't have as strong as demand as people thought. So you want to keep that absorption rate pretty much like 100 units delivered, 100 units absorbed would mean that someone builds 100 units and all of them get moved into. That means a lot of people want housing in that market and there's not a surplus. So that's another thing to look for. And yeah, I would definitely suggest that you study the market because, again, like I said, the 1,000 per door payroll average. Well, how do I know that? Well, I obviously have been in the market for a while, seen a lot of deals and asked a lot of questions. And that's why I have a benchmark to see that they are overpaying that guy. Because there were some questions like, well, how do you know that they're overpaying him? Well, it's because I've seen so many deals in Austin and that's the highest number I'd seen. So you have to do your research so that you even have a benchmark. So Bryce asks, what benchmark do you use to get the percent of GP per roll? Curious how that's assigned, i.e. 10% for capital raiser. Yeah, great question, Bryce. So that is, again, that's subjective and it's partnership to partnership. So it depends on what value you see that person having and how replaceable they are. I guess would be another like key business principle in general is how replaceable are you? Because as you become less replaceable, your percentage usually goes up. Then also, as far as GP roll, per roll is a different thing. It really does come down to personal. I can't really even give you like a benchmark for that. I guess the capital raiser is typically from 20 to 35%. And the asset manager, if you find the deal, you underwrite the deal, you came up with a business plan, you're probably closer to 50% of the GP there. And then the risk capital and the guarantor, those are typically from 5 to 10% of the GP almost all the time because the guarantor is just signing on the loan. So he is very important, of course, and you have to give him equity to incentivize him to do so, but he's not really doing any of the tasks fully. So he gets a little bit less. And then the risk capital, again, they're important because they're putting their money at risk because if you don't close, you don't get your inspection costs back. And that's something to consider. So of course you got to give them some as well. But typically the movement from like a 20% for capital raiser and a 35% for the capital raiser is totally partnership to partnership. As far as the GP to LP split, how that's determined by returns. So to see what the LP gets and then what the GP gets, because we're breaking up the GP, right? So we're breaking up the 30%. If it's a 70-30 split right now, we're talking about the 30% being split up. But if we're talking about the whole deal being split up between LP and GP, that typically comes down to what returns are you promising. So if I want to give someone a 15% return, then I have to give them however much equity is going to lead to that return. And that's kind of how it's determined as far as that's concerned. So yeah, feel free to ask any more questions. I'd love to keep answering it. As far as underwriting is concerned, trying to think of, okay, so yeah, let's see. Mario asks, what resources do you recommend to learn this niche? I would say number one and first and foremost would be just going and looking at deals on the LoopNet process that I was just talking about, where you're going to LoopNet, you're finding the broker's personal website, and you're just looking at financials. That would be another good thing. And I'm gonna send Matt all the financials that we just went over and the analyzer as well, so we can send it out to you guys after this, and you guys can all practice with these financials that I have you right here. Because the only way to really learn like underwriting is to underwrite. Unfortunately, there's a lot of other good books for the general idea of multifamily, like Crushing It in Apartments by Brian Murray. Again, that's Crushing It in Apartments by Brian Murray is a great book to get started understanding apartment investing. Also, Michael Blanc has a good book about it. There's several decent books about the overall concept. And, you know, Joe Fairless has a syndication book called Best Ever Syndicating Book or Best Ever Book on Syndication, something along those lines. You'll be able to find it. And those are good for general idea, but the actual underwriting, the stuff that we're talking about right now, you simply have to see deals and underwrite deals. And that's why I'm going to send you guys all the financials we just went over and also the analyzer itself so that you can just practice on these over and over again and see when you play with the numbers and you see, okay, if I change this number, what happens to the returns? If I change this number, what happens to the returns? And just seeing how everything affects everything, that'll really help you understand the industry. Cool. So yeah, again, feel free to put questions in the chat. Unmute yourself if you would like as well. And I will see if I can find another. Okay. I should probably start presenting as well. Great stuff, providing a ton of value. Yeah, of course, Felix. And nice to see you, man. I'm happy you're here. So let me see if we can go over a rent roll. I think that would also be really helpful for you guys. So there is two forms of financials. We have the T12 that we just went over in depth, which is profit and loss. But if we can go over the rent roll, which is going to show us who's living here and how much are they paying and things of that nature. Also, it'll show you obviously the occupancy and the vacancy. So let me pull that up. I think that'll be helpful for you guys too. And I'll also send you this stuff as well. So rent roll edited. So yeah, you guys should be able to see the rent roll here. Someone just chime in and let me know if that's the case. I'm going to just go on Faith and say that that's the case. Yeah, we can see it. Okay, cool. I'll go back to it. So the here is basically what's happening. I've color coded the unit types. So there's 3 unit types on this rent roll, and you'll see they have unit details. And so unit type, square foot of the unit, is it occupied or vacant? And then even the residents' names, maybe we should black those out. But either way, we don't know any of these people, hopefully, so it's fine. And then market rents, so you can see what the market rent is, which means the rate of the actual area. What are other people getting for similar units? And then what are they actually getting right now? So scheduled charges. And that's kind of the columns we're going to look at right now. So we have this 2-bed situation, and you can see that these are occupied. And then you can see this one down here is vacant. And we can see that they're pretty much around 1,000, somewhere around 1,000. And we can get them up to 1,200. So that's just a nice note to make. We obviously want to verify if this market rent is correct, because brokers will often kind of give you a higher number on market rent so the deal looks better. And that's because their comps that they pull are often not as accurate. But either way, right now we're going to trust that, and we're just going to go off of it for the simplicity's sake and say that the market rent's around 1,200. So that means we can add a couple $100 of value there, which is nice. Then we're going to look at the 1-bedroom, and you can see here that we have 870 for market, and they're currently somewhere around 850, 860. So not too much value on the 1-beds. And then if we keep scrolling down here, we have a 3-bed variant too that I've highlighted. So here's the 3 beds, and these are all occupied right here, and you have some down here. We'll see the totals at the bottom of the page, but here these are at 1,350 is what the market's at, and they're somewhere around 1,300. So again, the main value looks like it's going to be taking place on the 2 beds. Then if we scroll down here, we can see some of these totals. So we have let's see, occupied, no notice. So we have about total occupied units. So it should be, yeah, so we're 93% occupied. So we have a 7% vacancy here at purchase. So what day 1 will be at 7% vacant. And that, my assumption, if you remember back on the analyzer, was a 10% day 1. So I've been a little conservative there and said that we're going to be only 90% occupied day 1, even though they're currently running it at 93. So that's just something to take in mind, is like people may move out because of the change of ownership, and that's something to consider and also account for. So that's just a situation. And then we also want to know what the average occupied ratio or percentage is in Austin. And so that number's usually a little bit higher than 93, but not too much higher. So we'll have a couple assumptions where when we actually stabilize this and execute a business plan, what will our occupancy be there? And so we have to take into account these people are somewhere around 93, 94. So we want to have a couple scenarios where we're below this and a couple where we're above this, and then maybe one where we're right at 93.75. So maybe we run it the exact same as these people. Maybe we run it a little bit better, and maybe we want to run it a little bit worse. And I want to see what happens to my numbers when we account for that. So that's just kind of what you're thinking all the time. And then, yeah, so we have the vacancy here. And then we have here the vacancy per, or the actual, we have the vacancy per floor plan, which is important later. And then we have the rents per floor plan. So here I've made a little table for the actual gross potential rent, because they didn't give us the gross potential rent total. They only gave us the floor plans monthly. So we'll show you here what we did. I'll even highlight the formula. So I took to get gross potential rent, remember, we're assuming that we're at market rate, and we're assuming that we're at full units occupied. So here we have we've taken the actual total amount of units, and we've multiplied it by the market rate. So if everything was occupied, all 40 were occupied, we multiply this by market rate, then we're going to get the actual number, which is 34-ish thousand. And that's for monthly. So of course, for yearly, we times this by 12. So it's just that number times by 12. And then we do that for all the floor plans, and we sum the column here. So the gross is going to be 1.713 million. And that's just what we're going to start to go off of as far as market. And then of course you have to account for loss to lease, because of course these people aren't getting the market rent. So that's what loss to lease is the difference between these two numbers. And then we have vacancy, which is the difference between these two numbers. Because like we said, GPR is somewhat conceptual. It's theoretical in some sense, because it's impossible to be fully occupied. So we take that and then we subtract the differences, which is right here, that's loss to lease. And then right here, that's vacancy. So between rentable and occupied, that's vacancy. between market and scheduled, that is loss to lease. So we are subtracting those two numbers. And that's really what we're getting from the rent roll is essentially the vacancy, the unit type mix, and the different rents associated with the different units. So that's kind of what you're getting from the rent rolls. So yeah, any questions on rent rolls so far? It looks like we have a couple. Of me stop presenting and check this out. Okay, so I've heard horror stories of rent rolls being inaccurate when purchasing. How do you combat that to ensure all tenants are on current rent? Yeah, of course, Kyler. So basically, when you actually close on this deal, you have to get a verified rent roll. So you actually have to see the leases and verify this. So if the horror story does magically come true and you end up having a falsified rent roll, well, fantastic. You can back out of the deal for misrepresentation, which is totally fair. And that's because they can't verify. So I believe Nick is even on this call. Nick Emiluxon. Let's see if he's still here. He may have left. But basically, Nick was on this call a little bit ago, and we were under contract on a deal in Austin. It was 24 unit. And what happened was they had 2 units in Austin. So they had one where we were trying to buy, and it was actually like 60% occupied, but we didn't know that because they had taken all of their tenants from the other building they own in Austin, and they had given them like 3 months free rent to move to the unit they were trying to sell, so that they would have like artificially high occupancy for the current time that we were trying to buy it. So we didn't know that until we saw the actual real rent roll, the verified one, and then we were like, oh, I see what's happening here. This is like a Ponzi scheme. So that's kind of what we did. We ended up just backing out, and yeah, Matt's saying he's had the same thing happen. So that does totally happen, and that's why you kind of have to get those verified rent rolls, because there is horror stories of that situation happening, and that's definitely a possibility. But you won't ever get all the way to closing unless you just miss the step of getting the verified rent rolls, which I can't imagine that you would miss that if you had a professional management company. And also now you've just heard that story, so hopefully you won't miss. And yeah, probably it was the same company, man. It's in Austin. I don't want to put the people on blast, but I'm sure that it was probably the same company there. So does it matter to you if the deal is brought to you as an assignment contract? Basically, will you buy from a wholesaler? And do you care how much money the wholesaler makes about numbers? So again, yeah, it's all about the numbers. If I can still get my investors to return and the wholesaler has made a margin for himself, I don't really care. I mean, good for him, right? I mean, that's kind of his whole job. If he does his job well, I'm not going to punish him, right? So if he's been able to make a huge margin and still give me the property at a price where I can get my investors their returns, oh yeah, man, good, kudos to that guy. I'm not going to be hard on him at all. I'm going to be impressed. Honestly, I might have to talk to that guy and ask him what he does. So that'd be that situation. However, wholesaling is typically kind of rare in the multifamily space. I know that you've been successful at it, Matt, but you're kind of a unique dude. So I don't know very many people who are able to do that. And but yeah, I'm always open to people who are specialize in getting deals at low prices and being able to work a margin in. So yeah, it's a good method if you want to do that for people. That's definitely huge. Cool. So Matt, I'm not sure that I have too much more as far as the content is concerned. We can ask questions for sure. I'd love to help out. So yeah, how can people here add value to me? I guess the number one thing would just be, if you were able to find deals in Austin, I'd love to underwrite them and see if they pencil out, and maybe we can partner together. That'd be cool. That would be probably the biggest value add as far as that's concerned, because the team right now is decent as far as, and also, I mean, potentially, yeah, it would mainly be just finding deals. I'm not going to ask anyone to invest in my projects. That's a little bit messed up. So I don't really want to do that. And also, we don't even have any projects going right now, so it's kind of, invalid anyways. But yeah, if you can find a deal and you can explain to me what's going to happen with the coronavirus as far as, vacancy and rent and stuff like that, then I'd be interested to see. So Bryce said, did you invest passively before your 100+ unit in GP? Wondering which GP role you view as the transition from passive investor, 2 deals in 2019 to an active GP role in 2020. So Bryce, I was a very broke college student when it was not in a position to invest passively at all. I was actually negative money because I was in student debt. It's funny. The story is actually funny because the week before I closed on like a $5.5 million deal, I actually couldn't even afford my groceries. And my roommate had to buy them for me. So embarrassing, right? I think I'm a hot shot closing on deals, and the fees haven't obviously come in until closing, right? So I'm just essentially on an island broke. And yeah, I'm putting together this $1 million deal, all this cool stuff, and I can't even buy like lettuce at the grocery store. So that definitely was not in a position to passively invest. I had to educate myself in that sense. I would say the best transition would be from, if you're a really wealthy individual, it would be the guarantor, from signing on the loan and asking the GP, hey, I'll sign on the loan if you let me go to every single meeting you guys have, and you let me be on mute in the background so I can hear exactly what you guys say in those meetings, how you structure them, your whole process, and learn the whole thing. That would be a great idea. But then also maybe doing the same thing, but with risk capital. So maybe you put down the earnest money and you pay for the inspection costs and the legal fees. And then you ask them the same question. Hey, can you literally involve me in everything? And if they say no, then don't work with them. You know, like you would only want to work with someone who would say yes to that anyways. So it's kind of a good vet for you as well. It's almost like a win-win, because if they say yes, then cool. If they say no, then good. You kind of see their character and you don't want to work with them. So that would be my best transition. And then another one would be capital raise. So if you're a slightly wealthier individual and you know some other slightly wealthier individuals, then you would tell them, hey, let's all invest in this deal, and I'll be like a pseudo GP as a capital raiser. So that would be the 3 best transitional LP to GP. Sweet. So then we have, I don't want to butcher your name. Your last name is short and I apologize. So I'm just going to, out of being nice, I don't want to mess it up. So can we get that template sent to us? I'd like to mess around with it. Absolutely. Yeah. So I'm going to send this to Matt because I think that's the easiest way. He has everyone here's email, I'm assuming. So I will send it to him and then he'll probably send it out to you guys. I'm pretty positive that he does. So if not, then my email is kyle@kylemarcotte.com. In fact, I'll even type it in here in the chat just to make sure. If there's some reason that you don't get an email from Matt in the next couple of days, then feel free to send me an email with the subject line like, hey, TRE Homes thing, and you said you were going to give me something. Where's it at? So that's my email in the chat if you guys want to email me anything about that. So that's cool. And then we have Gustavo who says, how did you create the relationship with your syndicators and get them to trust you when still in college? Another great question. So I just addressed the situation, right? Have you ever seen 8 Mile with Eminem where he opens with all of the insults about himself and then kind of disarms the other people? That's kind of what I did, man. I was like, yeah, I'm 21, or yeah, I'm 20 at the time. Yeah, I'm pretty, like, I have no money right now, but I understand the concept really well. But the thing is, like, I'm going to work harder than anyone else ever would for your money. And number one, I don't have dependents. I don't have kids. I have no things like that to hold me back. It's literally like full throttle in real estate. I can stay up till 4 a.m. every single day for 12 months and make sure that you get your money safe. And I kind of just play it in that sense. Like, yeah, obviously I lack experience, but I 100% have the energy and the drive to make this happen. And also I know what I'm talking about, and here's the numbers to prove that. So I really knew that I had to compensate with information and knowledge since I was young and look young and appear young. So my credibility comes from the fact that I understand the subject really, really well, because I had to in order to build credibility. You have to almost know more than the average person in multifamily in order to make up for that huge age gap there. Because one of the other arguments that people would make is like, hey man, you're 20. How are you going to predict a 10-year outlook on a property when 10 years ago you were 10? You have no idea what 10 years looks like, right? And that's a decent point, right? 10 years ago I was 10, and I don't really understand how long 10 years is. It's hard for me to understand that because of just the time period I am in my life. So I would address that as well and say, like, no, I don't actually understand how long of a time period that is, but I do know all of the averages, and here they are. Here's the national data to back it up, and I'm going off of national data, and I'm being conservative on national data as well. So it's not about me and some skillful thing that I have. It's just me following the rules and doing everything to the letter and being conservative, and that's another kind of way to offset it, because you're almost leaning on the system, and you're leaning on how to actually that you've done your research. That's kind of how I combated that. So yeah, there's no secrets. It's a real grind, hardcore work, putting in the time and effort over a really long time. Do you agree with this? Sometimes people think it's easy, but I imagine for you, even at your level of success, it's a constant grind. Yeah, absolutely, man. Absolutely. It's a total grind, and there's a lot of stress as far as taking other people's money on your back and having to provide them a return. So if you're not ready for that whole thing, I mean, dude, I'd rather lose $2 million of my own money than $100,000 of someone else's. That's just kind of the way that it goes, because you just feel so bad if you were to lose that kind of money. So for me, I think that that's where the stress comes in, is making sure that you've crossed all your T's and dotted all your I's when you have that much of other people's money on your back. Especially in my case, people are taking a personal risk trusting in me as a 21-year-old. It's definitely like a really nerve-wracking experience, but that's why you just have to know your numbers even better. And it honestly makes me a better syndicator overall, because of the fact that, people are counting on me not to lose their money, and I've put myself in a position where I'm saying that I'm not going to. So you have to really be sure about that. Other than that, man, I say that it's a lot of fun too, because the feeling of closing like a real multifamily deal is pretty awesome. And it's a lot of fun, and it beats working 9 to 5. It beats having a boss. It beats a lot of that stuff, and being able to control my schedule and do things like this where I get to talk to people and they actually care about what I'm saying. Like, I've been talking for like, what is it, an hour and a half or something like that, or 30 minutes or something, and people are still listening. That's pretty sweet, man. I don't care who you are, right? That's pretty cool, and I definitely enjoy that. So that's definitely cool. Ivan asks, are you currently looking for investors for your syndications? Can anyone partner with you? So I'm not necessarily currently looking. I mean, I guess I'm always looking for investors, and absolutely, yeah, you can partner. If you send me an email, like maybe we can talk about it more, of course. So that's something. But right now, I'm not necessarily looking for deal. I am looking for deals, but I'm not necessarily in a deal because of the fact that, number one, if you're looking at the lenders and their approach to the environment right now, lenders are requiring about a year worth of reserves in order to even enter the deal. So that means that lenders are very bearish on the outlook right now. And to me, that means that we should potentially take heed of that and understand that there may be a situation where the banks know something we don't, or they're predicting maybe a second wave and a second shutdown. And that's something to consider, because even if you hear investors saying like, oh no, it's bull market, it's going to be V recovery, it's all fine, it's going to be great, I'm buying deals. It's like, well, the banks are kind of saying something else, and the sellers are not going to lower their prices right now because collections have been strong. So if the sellers are making the same money they were in January, why would they sell their property for less? And then the banks are, but the thing is, we can't get the same loans we could get in January. So the buyers are saying, well, the loans are way different than they were in January, so you got to lower your prices. And the sellers are saying, why would I lower my price? I'm making the same income. So there's a stalemate. And until that stalemate goes away, I can't really buy anything. And one of those things will give in. Maybe it's the banks and the economy does recover and everything's fine. Fantastic. I mean, cross your fingers for that. But then the other side of things would be the economy doesn't get better, the banks are right, and the sellers start lowering their prices to accommodate. So that would be, one of those things has to happen in the next 6 months to a year. So that'll be something I'm looking out for. So he says, for sure, man, I'd like to connect with you. Maybe play some soccer too. Yeah, dude, I would love to play some soccer. So if anyone doesn't understand the reference, I played soccer in college. And yeah, that was a lot of fun. I played Division I soccer at UC Davis. Played left wing, if anyone cares, probably not. But it was a lot of fun, and had to give that up as well to do this. So a lot of sacrifice, but super duper worth it. And I wouldn't trade it for the world. And yeah, I'd love to play soccer, Ivan. That'd be awesome.
Thank you for all your time, Kyle. We really appreciate this, and you have shared a lot of knowledge that I think a lot of people in here were craving and are going to benefit from.
Yeah, thank you so much for having me, man. I appreciate you guys.
Do you want to share with everybody maybe your podcast and how they can get in touch with you and find more about you and what you're doing?
Yeah, so if you guys are interested in the podcast, it's called Own Your Time, or the Own Your Time podcast, and that's available anywhere you listen to podcasts. So we talk a lot about multifamily, some mindset stuff as well. And yeah, as far as where you can get in contact with me, my website's probably the best place. So that's Kyle at, or just kylemarker.com. So that would be the best place to reach me, is kylemarker.com. And there you can download a free book that talks all about what resources you need in order to get started. So it has all the books and podcasts I've ever listened to, and also study questions at the end of every section. So you're able to kind of start to learn multifamily in that sense. And that's another thing on the website as well.
Love it, man. Yeah, thank you so much. Everyone here asked for a little bit of help, and we appreciate you reaching out. I'm sure some people are going to reach out to you independently. And guys, it's inspiring. Like, Kyle is just one example of you can do anything you want in this business. And like you said, it's a constant grind. Like even at this point, nothing just comes to you easy in this business. And at the end of the day, what I realized is this business is not for everyone. Like, it's hard. It seems great on the outside. Real estate's an amazing asset class, and it's an amazing industry, but you have to be constantly putting in the work. And Kyle's, perfect example of that. So thank you, man.
Thank you so much, man. I love that you guys put this on. It's a lot of cool stuff.
Yeah, awesome, man. We do it 3 times a week, and we'd love to have you back on when you do have a deal, and anytime you want to share anything else, I'm sure people would love it.
Yeah, of course. Let me know. I'd love to come on.
Cool. Thank you, guys. Thanks, everyone, for tuning in. Appreciate it.
Thank you, guys. Y'all have a good rest of your week and good weekend. Thank you, Kyle.
Yeah, of course. Later, guys.
Bye.
See you, man.